So welcome everyone, and really a very big thank you to myself and George for joining us tonight. Just a quick disclaimer before we get started. Australian Money Mentors confirms that any advice contained in this presentation is general information only. It has been prepared without taking into account any person's needs and objectives or financial position. So before taking any action, please always remember the appropriateness of the information and to seek independent advice. Now I'm going to pass on to my partner, George, and he'll get us started. Hi, George, how are you?
Thanks, Tony, and hello to everybody. My name is George Lambertides, and it's great to see you here all this evening, and we really appreciate taking the time out of your day to join in and have a listen. Now, I can see a lot of familiar faces in the audience from within Australia and even some of the guys currently overseas, but I also notice a lot of people who are hearing us for the first time, so I welcome all of you this evening. Whilst we're really conscious, guys, about sticking to the script of why we're all here and what you all signed up for, which is what the property market's going to look like during and post this pandemic, I thought it'd be a good idea just to start off by saying what's been really clear in dealing on the front line with people's finances is that current events have come as a big slap in the face for a lot of people, personally and or in business. Whilst a lot has been out of people's control because we could never anticipate it, hopefully a lot of lessons will also be taken out of it in regards to the way we think about and manage our finances moving forward. Now, I thought it'd be also a good idea just to give you guys a little bit of a background on who we are. So Australian Money Mentors was initiated by us because we feel that a lot of the challenges that people are facing, emotionally, around the way that they view their future and even the way that they're currently living is so highly dictated by their finances. That's why we're actually so passionate about it, because it's also such a big life topic that's currently neglected and has been neglected in our education system for so long. The way I look at it, some of us may be really fortunate to have friends or family which have passed on some of these skills. But I think across the board as a country, we really lack the understanding of fundamental good practices that can take the stress away and create relief and structure for a family. So what we've sort of found is it's all about small changes at the right time. And look, it might be through education, or just having someone to help or guide you through times when it's stressful or you're going through a big life transition. So guys, in a nutshell, Australian Money Mentors, it's an educational platform, and it was created to bring information to the people because we believe that, if people have the knowledge, they'll generally make decisions. And while this is all about, yes, of course, it's about creating wealth, I just want to make a big point of it that it's not only that, and we also want to support those who just simply want to take that stress out of their life. So this is why we're going to be putting on, I guess, a lot more of these events moving forward, and hopefully you guys will participate in more to come. But I don't want to ramble on too long, so I'm going to pass you back over to Tony so he can introduce our wonderful guests.
Thanks, George. By the way, for those who don't know me, my name is Tony Zekas, and I've spent the last 20 years in the finance industry. It's been a really eye-opening journey, and I can tell you in the early days, the discussions were all about creating wealth, purchasing property, and constantly moving forward. But unfortunately, what I've seen in recent years, it's becoming more about getting people out of bad debt and consolidating loans and parents guaranteeing loans. It's been a significant shift. And financial pressures are now closely linked to the other issues such as mental health, which is something we are seeing prevalent in today's society. So what I'd like to do is I'd like to start by posing a question to you all, just to take away and think of tonight. Would the current financial impact of the COVID-19 lockdown be as severe if everyone had 3 to 6 months of cash savings as an emergency fund? Think about that, 3 to 6 months of savings. Would we have seen so many people lined up at Centrelink? Would we have so many people in distress? So what's the cause? In my opinion, it's quite simple. It's a lack of financial understanding, which leads to poor money management. And what the COVID-19 lockdown has done is brought this widespread social issue to the surface and identified that a significant portion of our community that either lives on credit or paycheck to paycheck, or even on minimal savings. We've all done it at different times, we've all been there, and it's not something to be ashamed of, but it is something to correct, or it will continue to cause problems. enough of the negatives. Why are you here tonight? For most people, their biggest asset is their property. I think what we need to do is to understand what's going to happen, or at least think about what may happen to our biggest asset moving forward. So now let me introduce you to our guest speakers. Matthew Baxter, a leading property advisor with over 30 years experience in the residential and commercial Australian property market, and founder of Copperfin Property Advisors. And Maria Berto, Regional Director of Option Property Group, Australia's largest valuation company. Hi guys, and thank you for giving us your time tonight.
Thank you. It's a pleasure to be here.
Excellent. Matthew, do you mind if I start with you?
Sure.
And I'll give you the first question.
Yep.
What I'd like to know, and probably what a lot of our audience would like to know, has my property value dropped?
Yeah, good question, Tony. And it's a question we get asked quite a lot. And I think to be definitive, it's probably too early. But the most most probable thing is that it probably has dropped to some degree. And I think there's a lot of unknowns, but really what we do know at the moment is that demand for property, as soon as this COVID crisis sort of hit early March, demand dropped off for property quite a lot. We know that unemployment's increasing. We know that the business and consumer confidence has dropped right off. And we know that bank lending has become harder. So banks have tightened up their policies again. But probably on the positive side to all of that, if there is such, is that demand's dropped off, but also supply of property to the market has dropped off as well. CoreLogic records show that across Australia that there's 27% less properties on the market right at this moment than there were the same time last year. And of course, if demand drops off by a similar amount to supply dropping off, then we should have some sort of equilibrium between the two. So that's good to know. And I think a couple of things the government have done have been really good, which is they've introduced this job keeper and job seeker allowances, and they're quite generous, together with lower interest rates. I think what it means is that just for the short term anyway, that people don't need to sacrifice their property on the market. So that's good, because Australians, our psyche, and everyone here I think would agree with me, none of us like to sell our property at a loss. You know, we hold property in Australia really dearly, more so appears than a lot of other countries. So, you know, with that in mind, I think to summarise an answer is that, look, properties that have probably dropped off, what I'm seeing in the marketplace is that some properties are still selling for, if you like, pre-COVID prices, whereas other properties are probably discounted a fair bit further to achieve a sale in the last 3 or 4 weeks. So we'll know more in the next few months, but at the moment, my anecdotal feel is it's probably about a 5% drop on average, but some properties, so the quality properties, are probably still achieving the same amount.
Yeah, beautiful. So Matthew, I'll just jump in for a moment.
Sure.
Obviously, that's in relation to property at the moment, what's happening at the moment. But one of the other questions that we also wanted to pose to you was, what are you forecasting about the property market once we come out of lockdown? I mean, we have all these COVID restrictions and that's all sort of finished. I mean, there's probably a big portion of our audience at the moment who are currently holding off buying or selling their property. So what are your thoughts on that sort of once we come out of this whole COVID-19?
Yeah, thanks, George. Well, again, it's very hard to tell because there's so many parts to that and attributes that will go into it. I think what we can look at is to say, well, how long is this COVID and this lockdown crisis going to last for? And the longer it lasts, the more chance there is for a more sustainable drop, if you like, in property prices. So the things I'm looking for really is, how quickly we can actually get back to normal in our normal business cycle. So I'm looking at business confidence levels, and I'll be looking at that on a monthly basis. Unemployment levels. So when this ends, how quickly will our economy recover? And I think that'll be really important and a real key. But at the moment, I noticed that the state governments around Australia in their budgeting forecasting are probably saying that they're budgeting about a 9% average drop in prices. And I probably see no reason to move away from that. That's probably a fair assumption. But I think that there's going to be probably a lot go into that. You know, some properties, as I said, will achieve what they would have achieved pre-COVID, whereas others will get hit harder. From a commercial perspective, I think we'll find that properties that have got really secure tenancies and secure income flows with good tenant covenants, they'll be sought out and they'll actually achieve really good prices. Whereas other properties that have got a riskier tenancy profile will probably get hit a bit harder. So it's hard.
Around sort of the recovery of the property market.
So what are my thoughts about when it will recover?
Yeah, like, yeah. So are you suggesting that we're going to have a recovery of the property market once we've sort of come out of what you're talking about, obviously the 9% decrease in property values at the moment?
Yeah. So, well, what we know is, property markets, and we all know this, are cyclical. Melbourne and Sydney, I guess, were come off big highs in 2008 and sort of dropped off a bit. Brisbane probably was more sustainable apart from the apartment marketing in Brisbane. And I think that, so the real question is probably when will we get back to that normal cyclical sort of function? And that's the whole economy, so not just property, because property will feed off that. And what I'm really impressed with, if you like, George, is that how this crisis has shown that Australian business and is very innovative. So we find ways around things. I've noticed that Foot Locker have closed all their stores, yet their online sales have quadrupled in the last 4 weeks. I've noticed that real estate agents who have gone through so many hurdles, if you like, in terms of what they can do, how they can sell properties, can't have auctions, can't have open for inspections. They so quickly adapted and got around that through virtual tours and so forth and virtual auctions. And I noticed we've got Maria today from Optian, and I know Optian were really quick on getting on board with the virtual valuations, within really days of this sort of occurring. And I think that's a really good sign for the Australian economy. So, look, again, I'm going to be looking for those key indicators as to when we can come back from the property market, and I'm hoping we'll bounce back pretty quickly into our normal cyclical function. It's going to take a while, and there's going to be a few things that will change in the market, but hopefully it'll bounce back pretty quickly.
Thanks, Matt. Okay, Maria, I'm going to over to you because I just heard Matthew mention something, and he mentioned that businesses are becoming more innovative in the way that they're conducting their business. And I know we were sort of chatting about this earlier, and that Optian have come up with some innovative ways in which they're actually valuing properties at the moment, whilst having to navigate the whole social distancing rules. Can you explain to everyone a little bit about how they're going about that at the moment?
Yeah, absolutely. Thanks, George. So Optian, and as Matt said, we were very quick to come up with a solution for the potential. I guess early days no one really knew if we were going to head into a complete lockdown period, if we were going to be confined to our homes. We didn't even know if valuers were going to be essential services, because we did see across around the world just the way valuers were treated were different in different parts of the world. So we know in America, for example, they were treated as an essential service, so could continue working. But in New Zealand, they were unable, and when there was a lockdown, they weren't able to work. So very quickly, Optian, our innovation hats came on, and we created a virtual valuation solution, which is essentially, it essentially allows valuers to continue to value properties without internally inspecting them. So that is one of the issues that we're still facing in the property market and for valuations that we are currently undertaking. Our government body, though, has come on board as well and have also set up some protocols for us to go through so we can continue valuing. But essentially, our Optian virtual valuation works through a stepped process in terms of if we can't internally inspect because of COVID-related issue, and when I say COVID-related issue, it means that we can't go inside the property because someone might be in isolation or might actually be unwell, so we don't want to put anyone at harm by going inside a property. We have a product that it's a photo upload as well, or a video upload, as well as an interview with the home applicants to get all the information that we need about the property so we can continue to value properties and so people can get their loans as well. So it is relying on the home occupant to give us the information that we need. So it is a two-way stream, and our valuers are very good at asking for the information and walking the customers through what is required. But we do very much need to rely on what they're providing us. We are fortunate though, we have a very extensive database at Optian. We complete over 350,000 valuations a year. So we do have a lot of data and information that we can rely on, as well as using a lot of online sources. So any property that's under contract, there's a lot of information online that we can start the process before we even speak to the home occupants.
Excellent. Maria, one thing that I'm finding very interesting is the whole comparable sales situation. At the moment, you guys would have comparable sales that are pre-COVID that would normally be used for valuation process. How are you guys, are you basically taking a conservative approach when it comes to doing the valuations, considering what the prices will be coming up in the near future, even when we come out of the COVID situation?
No, it's a bit of a misconception. I think a lot of people think that valuers, we just come in, we're quite conservative, we undervalue or whatever it might be. It's actually not the case. We in majority of the cases, we need to use a direct comparison approach. So that's comparing like with like in those sales evidence. But Tony, what you touched on is where there is that lag of sales evidence. So in a COVID-19 environment, there are limited sales, but there are still sales. So for those that don't know on the line, valuers tend to follow the market rather than set the market. And that's generally because of the lag of sales evidence, and then also the reliance that we are required to use, which is settled sales. So we interpret the market, and this includes a number of different factors. So we have to look at current sentiment, market activities such as sale rates, and looking at the risk profiles. It's really important that, especially in this type of environment, that we speak to the professionals in the industry as well, so other real estate agents, builders, developers, to really research and understand our market so we can find those best sales, and so that we're across the sales evidence so we can put that accurate figure on our valuation reports. Oh yeah, I was just going to say, so we want to, like things like we like to and need to know is understanding how long properties have been on the market for, sale inquiries. So if you're in new land estate, just really understanding each area is a bit different. So valuers really need to understand their market in order to value it. And then in terms of the comparable sales, it's a mixture of things that they look at. So although there might not be the one directly comparable sale, there is always a sale that a valuer can use. You just need to make it's the least amount of adjustments that you're making to the sale, which gives you that more accurate interpretation to be able to put the value on the property.
Thank you. That's a good answer. Matthew, can I just ask, so based on all of these conditions, should I be selling, or should anyone be selling their property in the current market?
Yeah, good question. And I think that when you initially hear that question, I would say, why would you sell in this marketplace? But there might be some really genuine reasons why you need to sell. It might be that you've exhausted all of your financial capabilities and you haven't got the confidence that you'll be able to continue paying for the property. And that might be a good reason why you might need to sell. But probably thinking about it, what I would suggest, though, that you make sure that you get proper professional advice, if you like, to make sure that that's the case and that you've considered all your options. Often there's workarounds. And I mentioned before that some properties are still selling at pre-COVID prices at the moment. And one of the keys to that is that generally when you have a black swan event like this, and we saw it with the GFC and when I started in property in the recession we had to have in 1989, 1990, is that there's still demand. That demand will actually go towards the quality property first. So, flight to quality, you've probably all heard that terminology before. So there might be some properties in this marketplace that are actually good to sell. And there's as I said before, there's less properties on the market. So for certain pockets in certain types of properties, you might well find, Tony, that it's actually a seller's market because there's not the supply on there. But I mean, there's a lot of other reasons why you might sell. You might find a property at a good price and you say, well, okay, I'm prepared to sell my property at a theoretical loss because I've actually purchased something else that's good as well. So, or just thinking it through, that you might be in a situation where you need to sell for financial reasons, for family law reasons, for other reasons. So I think the key to it is two things I could leave people with: is seek advice, whether it be through a lawyer, a valuer, or myself, or yourselves, Tony and George. So seek professional advice to make sure that you've got all of the information that you need to. And the second part is that do yourself the best favour in this marketplace. If it's a residential property, make sure that you're presenting the property in the absolute best light you possibly can, because this is the marketplace where there's the deviation, as I mentioned a couple of times, between a quality property and a badly presented property will be at its greatest.
And I might just jump on the back of that, if I may, and just
Sure.
on what Matt was saying. It is really about the relationships at the moment, especially if you're in the market to be purchasing a property. A lot of agents are selling properties offline and to their databases. So really building those relationships and understanding what is being sold around you is really important at a time like now. Really just keeping an eye on what is selling, talking to the professionals so you're able to make that informed decision. And like what Matt was saying, a lot of properties right now, depending on the type of property, they're not all of them are coming in lower than expected. So there was even just one on my street recently, which was only on the market for a week. And by the time I called the real estate agent to find out, what they're asking for and everything about it, he already said it was under offer and it was contracts pretty much already signed. So unfortunately missed out on it. But when hearing what it sold for, it was at current market levels. There wasn't a dip because of COVID, and that was only 2 weeks ago now.
So that was, Maria, that was it, Double Bay, $30 million house, was it? Or
you got me, Matt. So it is important to build it and have those relationships at the moment, because it is it's very important.
Yeah.
Matt, so on the flip side, what about buying? Should I be waiting till after restrictions have lifted, or is it a good time to buy now?
Well, I guess I'm reminded, if you like, of the old saying that the rich buy when everyone else is selling and sell when everyone else is buying. So if you're in a position to buy now, it's probably a good time to get a quality asset, depending on what you're looking at. And if you think it through, and what I advise all my clients is that you never look at property in a short-term basis for an investment unless you're a developer, that really you should be looking at properties on a longer-term basis anyway. And through that longer-term part of that is you're moving through, if you like, the little humps in the market like we're seeing at the moment, or it's quite a big hump. You're smoothing it out. So I would suggest that if you've got your ducks in a row and you're in a position to buy now, then it's actually probably a good time to find some quality assets. And probably the one thing I'd leave you with is that in this marketplace, the buyer that will get the best deal, so to speak, is one that's got everything ready to go and doesn't need to rely upon finance, so that they've got they're readily in contact with their bank so that they know exactly what they can borrow, but hopefully that they've got pre-finance approval, and they've got their legal opinion, their property advisory opinion. So get your ducks in a row, and if you're in a position to buy, it could be a good time. And I can see that there's a comment on from Stavros, does that go for the stock market too? And I think he's saying Stavros is a good time to buy stocks. Well, I'm not a stock advisor, but probably a similar thing too, that if stock, if it's at a good price, seek your advice, of course, but it could be the similar.
Beautiful. Well, guys, I'm going to push on a little bit with the questions, because some people have sort of expressed some of the things they want to hear before tonight when they've registered. And one of the most common ones that we're sort of seeing at the moment is, and Matt, this may be a question for you, what happens to the people at the moment who are landlords and their tenants has been paying their rent? I think that's been a major issue, and there's been a lot of confusion around that, especially over the last month or so.
Yeah, well, there's slightly different between commercial property and residential property, George. But if I start with residential property, is that there is some state government incentives, and there's some state government mandatory codes that were issued to landlords last month around residential rents. And basically, The test is if a tenant has suffering hardship, and hardship is being defined as that they've had a drop of income by 30%, or that their rent at their drop of income will exceed 30% of their income, then they can have to prove that through a pre-formatted form that they need to fill out. And the landlords, via their agent or directly, is required to negotiate, if you like, a hardship rent for that. But once that's done, that can be signed off in a preset form, sent into the government department. And I think that the landlord will actually receive, or through the agent, will receive some sort of recompense for that. And it's on, I think, a monthly account that the tenant needs to actually account that they're still got a less reduced income. And I think that there needs to be some sort of arrangement, if you like, to pay that back. But on a commercial basis, it's slightly different because it's a national code, and that's the national mandatory code for COVID-19 in commercial leases. And again, it's a 30% thing. If the tenant has had their income, their turnover reduced by 30%, then the landlord and the tenant, the landlord's required to negotiate with the tenant, if you like, a reduced rent. And with that reduced rent, if you like, during the COVID period, 50% of that reduction is by way of a rent abatement. So then it just waiver that 50% of that, whatever they reduce it by. And the other 50% can be recompensed by the tenant over a 24-month period once we're out the back of this COVID-19 period.
Okay, so you're saying now it is more of a hard and fast rule, because I know obviously when these things were introduced and the government was, just encouraging a lot of landlords just to sort it out with their tenants.
Yeah.
And a lot of people really confused about that, and I think some people probably still are. But what you're suggesting here is that there is obviously legislation put in place to help solve those issues.
Yeah, correct. And it was very ambiguous at the start, George, and I received a lot of calls, if you like, particularly in the commercial front, about is it just a guideline? Is it mandatory? What do we do? And I think it started because Scott Morrison came out at the start saying, we're just expecting that there'll be some conversations between landlords and tenants. And it wasn't mandatory at that stage. And in fairness to all governments, that everything's happened so quickly that I think it's caught everyone by surprise, and they're playing catch up and putting in rules so quickly. But my understanding is it's mandatory.
Matt, another popular question that we have come from a lot of our investors and wannabe investors. So give us some insight. What kind of property class, example, resi versus commercial versus industrial, is going to be, in your opinion, the most attractive types of property moving forward?
Yeah, this is a constant question even outside of the COVID-19. And it will, without sitting on the fence, it'll really depend on the person's situation. And for example, I sit down with a lot of my clients and work through what their end goal is, if you like. What are they trying to achieve in their property purchase? And often, I'll have clients that are looking for more capital appreciation. So they'll want to buy assets, if you like, that have every likelihood of appreciating at the greatest rate, but mightn't receive the best yield. So the best income as a comparison to the purchase price. So we'll run through that, and a number of clients, if you like, are probably planning more for a passive income, Tony, so that they're saying to them, and I actually work through a preset format that on some software that we've produced that just basically works through clients and gets them thinking, well, what are you looking for? If you're looking for a passive income, when do you think you'll want to achieve that by? And we work on a plan to buy certain types of properties that either are there for capital appreciation, or a mix of capital appreciation and a mix of good yields. So that might be some regional properties or some properties on the outside of Melbourne, industrial properties. That's a bit of a flavour of the month for me at the moment. I'm probably steering away from retail, whereas a number of my clients, particularly a few years ago in their self-managed super funds, really like to buy retail strip shops. But and it might well just be my opinion, but I'm sort of worried about retail going forward. That potentially for my clients, I'm saying, look, maybe don't weigh yourself too heavily into retail.
What are your thoughts on the whole? A lot of people have gotten used to this whole working from home, and I think there's a shift of attitude towards having to go into an office and having the same amount of floor space. What are your thoughts there?
Yeah, absolutely. I agree totally with what you're saying there, Tony. Is that when we come out the end of this, if you like, COVID-19 period, I think that there will be a few things that will change, and one of those will be that a lot more people will say, "Gee, I actually don't mind working from home and I can do this." And employers will be looking at it and saying, "Yeah, look, we can have a certain amount of our workforce. They don't need to come in all the time." And they'll reassess, if you like, their floor plate needs and how much actually space that they need for offices. And there'll be a lot more, which was a trend anyway, but a lot more hot desking occurring. So I tend to think that the per square metre for a company floor space for offices will actually start decreasing. So I agree totally.
Maria, can I ask you a question on that? You work for an organisation that has a lot of employees. How have you guys found the transition to working from home? And do you think it's something that'll be adapted more rigorously moving forward?
Yeah, absolutely. So for our valuer workforce, to be honest, a lot of the teams, especially in the residential space, were already working from home. They're out in the field every day inspecting properties. So to make them more efficient, they would naturally, after they finish their inspections, return their reports and would go home to continue to work. Where our business have adapted to this is all our support staff now working remotely, and we've been able to transition that quite well. And I'm sure just what Matt has said, it puts back into businesses' minds, how can we move with this going forward? So it might not be everyone, but at least we know as a business we can operate remotely and continue to do business, which is a positive.
Maria, can I just ask you a question? I mean, you've mentioned, I think, opt-in sort of in New Zealand and in the US and all through Australia. How many valuations a year would you do, just to give us an idea of the data sets you come through?
Yes, so it's at least, I know for Australia-wide, it's around that 350,000 vals a year.
Yeah.
We have about 450 plus valuers in Australia as well. So we do have that largest geographic coverage. So it's really rare that we would be unable to inspect and value a property. And now in this virtual world, and I saw a chat come up as well around their accuracy of a virtual valuation, they can be still quite accurate. We have a lot of data and tools that we can use and rely on to be able to do the valuation. And as part of our virtual val, we have our own internal risk assessment, and we won't proceed with the valuation if we haven't met our own risk assessment. At the end of the day, we need to be really confident and comfortable as a valuer to be able to put our value on the property, knowing that we have all the information to be able to do that. So we won't proceed with that valuation if we don't have the information that we need. Our virtual val is still a full liability product that the banks and our insurers cover us for. Our insurers cover us for, but the banks require it as well. And it's not just the value, it's also a risk assessment. So they go hand in hand, and that's the information that the lenders typically want from us as valuers.
Beautiful. So Maria, while we've still got you, one of the next questions we sort of wanted to lead into as well was how are you guys currently treating sort of off the plan versus established purchases? Because, and for those of our viewers that don't know the difference, obviously when someone purchasing off the plan, there's a gap between the purchase date and the settlement date. And the property is subject to volatility in that period, which can pose a risk for that purchase. So how are you guys treating it? Because I'm sure there's some people out there at the moment which might have purchased and then COVID came in and now they're sort of stressing because they've got a settlement date fastly approaching.
Yeah, absolutely. And the off the plan versus established market, in terms of how the valuation is undertaken, that's the same process in terms of the comparable sales evidence and the sales that are available at the time. What is different with off the plan right now is like what you just mentioned, George, is the time of when they did sign the contract. So typically that's, anywhere between 9, 12, even 18 months prior. So the markets can be in a very different time to when the valuation is then ordered closer to settlement dates. So off the plan, and especially the off the plan apartment market, this is typically a segment that has felt pain prior to COVID-19. So I guess if we see market conditions continue to worsen and as more evidence becomes available, that will potentially show a decline in market values, especially around that off the plan. I'm talking more so the off the plan apartment market than your off the plan smaller sort of townhouse development, although similar impacts can be felt. I guess what's important around this time is just understanding other sort of risks in the market at the moment that generally affects this market segment. So, the shutdown of interstate travel and also interstate buyers, the reduction of international buyers just across all markets, that in itself has reduced it's lower, and those international buyers, they're finding it more difficult to settle their properties because of these restrictions as well. What's fortunate is that there is, like, the lenders and everyone's working together to try and get properties to settle. So from a valuer's perspective, we're not going out there to, purposely try and knock that back. We just need that sales evidence to support what those figures are. But again, depending on what was purchased, the market does change.
Beautiful. Well, while we're actually on that topic, Matt, I'm going to cross back over to you. I mean, while we're talking about off the plan versus established, I mean, what's your opinion for people that are considering those type of purchases? And obviously, we've got an Australia-wide audience, so I don't know whether you talk state to state, versus apartment. You see those commonly bought off the plans. Geographically, what are your sort of thoughts around established versus off the plan purchase?
Yeah, and I'm probably biased, and this is a pre-COVID thought pattern too, George. It's not just because of COVID, but I probably steer my clients away from off the plan purchases, and for a lot of the reasons, but from a different lens, as that Maria's just mentioned. I look at it and say, well, there's settlement risk because you don't know what your financial position is going to be when you need to settle. So there's a risk that you mightn't be able to settle. That's one. There's also a risk that the value mightn't be the same, and we've seen that a lot in the last 5 years. So I steer them away from that. And from probably a couple of practical reasons too, is one, is you don't know what you're going to get is with off the plan, is because you get a glossy brochure, but all too often I've seen the end product is very different to what the glossy brochure that you think you're going to get. So, and probably another innate thing too, that is talking about apartments, buildings, and a lot of my clients have bought in Melbourne, Sydney and Brisbane as well, is that every apartment block has its own idiosyncrasies, if you like. It gets its own reputation, and that reputation's based off build quality, and a lot in Sydney in the last 2 or 3 years about build quality of apartments, but also the buyer mix in those apartments. And sometimes those two, you don't know what that's going to be until the actual thing's been built and people have moved in. You don't want to move into an apartment block that's 100% tenanted, and particularly if they're student tenants or whatever it might be. And I think not that there's anything wrong with that, but if I've got a client that's potentially looking as an owner occupier, I don't want to put them into a building that's all tenanted, if you like. So I tend to want to steer away from that. Hey, George, do you mind if I take 1 second too? And Tony, I noticed in the chat there just earlier on, I meant to mention this, that is it David Barrett? You mentioned that isn't the value of a property dictated by the amount you can borrow and service debt? Absolutely. Property is like any product, it's demand and supply. And it's the demand will be a factor of what people can borrow and how much money that they've got. So you're absolutely correct, is that's one of the elements that make up those demand side factors. So absolutely right.
What about house versus apartment, inner city versus outer, state by state? Is there any tips you can give our audience? Yeah,
well, and I shouldn't be asking me, sorry, I've jumped in over the top of Maria, but
that's right.
Thank you. Again, I mentioned before about building a portfolio and building, if you like, a strategy of what you're looking for. So it depends on the client, what they're looking for. So if it's on an investment front, the one fundamental, if you like, I try and start with my clients is to understand the dynamics of property. And I don't know if everyone here's heard the terminology before, that land appreciates and buildings depreciate. So what you're trying to look for, if you're looking for a property you want to see capital appreciation from, you want that property to have a stronger land component. And it doesn't necessarily relate directly to size. It's not a direct one-to-one correlation with size. It's more that value component. And if I can use the example that if you buy a property for $500,000, you might buy a house, if you like, in the outer suburbs, or that where the land component's $300,000 and the building component's $200,000. So it's a really good mix where the land is greater than the improvements. Whereas if you buy an apartment at $500,000, it might almost be flipped, or even more flipped, where the land component might be $150,000, even though it's only a small part, that your share of that body corporate land component is $150,000, and the bulk of it, $350,000, is improvement. You tend not to get the same capital appreciation profile from that. But on the counter side is that you'll get a stronger yield, because rent, if you like, in a free market, is a component of the depreciation of the improvement. So you'll actually get a stronger yield from those sorts of properties. So it's all about, Tony, if I can say, is building that right plan, working out and sitting down before you actually buy and understanding what are you trying to achieve from this purchase, and then building a bit of a plan around it. So, a few of my clients have units and apartments, and they might have some housing, and they might have some industrial and commercial property as well, depending on their profile and what sort of portfolio they want to build.
May I just say something if I can?
Certainly.
It says Gina, but it's actually Graham.
Okay, I was going to say Gina.
Yeah, she's an ugly woman.
Lockdown's done strange things for all of us.
Don't worry, you should see the way I dress. But my question would be, when you're talking apartments and that, and the volume of land you have is actually minuscule compared to the actual investment you put on it for it. Like if you put in 500,000, there's only about 100,000 odd, if that, invested in the land.
Yep.
And you're saying that rent could be the positive side to that, though, in a return. What about the body corporate side of it? Like, I've got a mate that's got a place, and the body corporate on his is $12,000 a year.
Yep.
Close to coming up to retirement. So where he thought he was on a really good thing with a $1 million property.
Yeah, really good question, Graham. And it's something, when you're looking at buying a property, that you've got to take into account. And we call it the internal rate of return. So you might look at something over a 10-year period, and you don't just take into account the buy-in price and the rent. You actually take into account the actual cost of ownership as well. And it's that bottom line figure that you're looking at. In a perfect market, if markets work perfectly, the internal rate of return, and I'm just getting distracted by your glass of scotch there, by the way, but the internal rate of return would be similar, because the market should take that into account, but it doesn't always. So it's a really good point, and why you need to do your homework before you buy anything, because a lot of people don't ask about owner's corporation costs. And,
well, he jumped into it. Like, when I say jump into it, he did all his homework and everything like that, and it seemed like a good idea. It was around $6,000 annually. But they quickly, once they got into it and everything, and he got onto the committee and everything like that, and they decided they needed a very strong committee.
Yep.
They decided that $6,000 annually was not going to cut it for the size of the properties they had to manage and everything like that, and insurance, and it was a new property, therefore they had to get things checked over again, building surveying again, and all that sort of stuff, just to get things tidied up, legal fees with that fire, the gizmo with all the fire stuff that was going on, cladding and all that sort of stuff. They had to, there was a lot of legal fees and everything that had to be chased up. So it jumped, it virtually doubled, and they probably need to turn around and up it again. But I think a lot of body corporates are probably under what they should really be.
Yep. Well said, Graham. I think you've offered people good advice, and probably another reason why you need to know, I call it, you need to know the unknowns. So what don't you know? So
exactly. Yeah, just another thought. Yep.
That's why local knowledge is key too. That and I mean, Maria said it a couple of times about talking to people and talking to people at coalface agents and valuers who actually work that specific area. They know the ins and outs. They know what side of the street is the right side of the street to buy on. They know what, and I've often spoken to the apartment valuers in Melbourne and Sydney, Maria, for Optian, because they know every apartment building and they know, what side gets the views and what side doesn't, what side is going to be built out eventually.
Yeah.
It's all those
exactly
little,
right.
Yeah.
They know all the developments that are going on up around them, what different levels and aspects, and they need to know this to be able to put that accurate, valuation and report back to the customers.
Yep.
Guys, just before we finish up time, because we want to let people get on with their evening, Matt, Maria, each of you, have you got any final tips or any advice, information for everyone that's listening?
From my end, I think it's just echoing what we've said earlier, and it's really just making sure that you set up and have these relationships with the professionals in the industry. It can be in any form, whether it's agents, builders, developers. Just really ask the questions up front and know what especially if you're looking to buy in this type of market, or even just trying to get loans or whatever it might be. Speak to your bankers, brokers, financiers. Really understand, get all the information so you can make an informed decision. That would be my recommendation at the moment.
Matt?
Yeah, I'd mirror what Maria's just said. I think that actually just seeking the right advice, and I think that's probably been a call out that we probably didn't plan to, but we've all said several times tonight. And I'll just actually also answer Damien Kalia just mentioned there that what impact do you foresee a potential shift in demographics, trends expected post-COVID? And one of the things about buying property is that if you stick to the fundamentals, you actually you're well placed with those sorts of things. And one of those fundamentals that we look at is to make sure that you're looking at the infrastructure that's in the areas that you buy. So we like to actually concentrate on buying properties where there's good infrastructure. So good freeway links, good schools, good shopping centres close by, and that's from an investment point of view. And that tends to actually, you're following that investment trend going forward and following the demographics.
That's also reflected for the valuations, and when you're coming up with that level of value as well, there's going to be good properties and ones that, that maybe don't, whether it's located on a main road or close to power lines or whatever it might be, they're the additional risks or notes that would go into the valuation reports and that we would, send back to the clients when you're getting the property valued.
Yeah, okay. Yeah, good.
Awesome, guys. Look, once again, thank you all for joining us tonight, especially to Matthew and Maria for giving up your time. Look, for anyone, I know there's a lot of questions that have come up in the chat and a lot of people that have sent me SMSs. For anyone who'd like to talk further with either of Matthew or Maria, please contact us at any time and we'll connect you. Now, I'd like to leave you with George and mine's final thoughts. So why was AMM born? It was born to fill the gap that we identified as one of society's biggest gaps in knowledge, which is around money, leaving people unable to make informed decisions to better shape their financial future. Australian Money Mentors is not just about treating the problem, but more so prevented it in the first place, simply via education. It's that simple. If we have the information, we can make informed decisions. In the coming weeks, we will email you out a short feedback form for everyone that's attended to complete. This helps us choose the topics moving forward that are of interest to you. In the meantime, please feel free at any time to reach out to us, even if it's just a chat, just to tell us how you're feeling about how things are going, or you need assistance on an individual basis. We are here to help. Thank you, everyone, and good night, and good to see you all.
Thank you.
Thank you.
Thanks, guys.